The 2023 Investment Outlook.
All right, Happy New Year, everybody. We've got a special long edition of 3-Minute Macro for you. We're going to talk about where we've been, we're going to talk about where we're going, and most importantly, we're going to provide some actionable ideas for the year ahead. I hope you guys like this outlook. If you do, like, subscribe, leave me a comment. Let me know what you think I got wrong. Let me know what you think might happen in the coming year ahead.
Let's paint a picture of where we've been so we can better understand where we might be going. The last 10 years were really one big bull market. Even though COVID was technically its own recession, I like to think of it as the inevitable blow-off and the irrational exuberance of what was really the previous 10 years of stability. So stability creates this instability, and the instability is what we're involved in right now. One of the main drivers of the stable economy of the last 10 years is the low rate of inflation we've experienced. This all changed with COVID, though. The huge fiscal policy response, supply chain problems, and then the commodity boom through the Ukraine war has all led to inflation being higher than a lot of people expected over this period. And so now the Fed is being very aggressive, trying to fight inflation and snuff out growth.
Okay, it's easy to beat up on the Fed with the benefit of hindsight, but in reality, they've gotten all of this really wrong in the last few years.
The Fed's been caught flat-footed at points in the last few years. The biggie, obviously, was the 2021 inflation, when even with the speculative fervor in place, the Fed kept interest rates at 0%, even while inflation was starting to tick higher. But going forward, I think the question now has to turn to, is this the return of the 70s? Or is this starting to look more like a 2008? And if it is looking more like a 2008, is the Fed at risk of making another policy mistake? The COVID boom was really a housing boom, as home prices surged 40% during the work-from-home era. This is worrisome in large part because housing is the economy. It's over 30% of GDP and 75% of household debt. And so what the Fed is doing now is primarily working through mortgage rates as mortgage rates surge and puts the halt on everything involved in the housing market, thereby creating the risk of a potential mini-style 2008 environment.
In last year's outlook, I spent a lot of time talking about the irrational exuberance of the 2020-2021 bull market. A lot of that's come out of the market, though, so let's put some of this back in perspective.
The irrational exuberance of the COVID boom led to an 80% plus increase in the stock market. We've given back about 20% of that so far, but right now, the stock market seems to be grappling with just how deep is that previous chart going to get? How deep is that housing recession really going to be?
All right, let's talk about asset prices going forward. But in the context of doing so, we're going to focus on probabilities. Great investors think in terms of probability distributions. They don't think like gamblers in an all-in or all-out fashion.
Any conversation about asset prices has to start with the most important question of the day. Where is inflation going? I think that 2023 is going to be the year of disinflation, the year of a falling rate of inflation. My base case is for core PCE to fall to 3% by the end of 2023. It's not going to be a super interesting year. It's just going to be sort of a muddle through, but the trend is going to be a persistent disinflation. The outlier scenarios are the return of the 1970s. That involves a wage price spiral, commodity surging. The Fed's going to be very, very aggressive in that sort of a scenario. The alternative is a deflation, a 2008 scenario where housing crashes and you get a real true deflation in prices. Even with my previous base case estimate of 3% core PCE by the end of next year, that still means that the Fed's going to be way above their expected target of 2%. That means that my base case for what the Fed is going to do with interest rates is that they're probably going to sit tight for all of this year. They're going to move to 5 and they're probably going to just hold it. The alternative scenarios are a smooth landing scenario. That would mean that inflation actually moderates faster than the Fed expects and gives them a lot more policy flexibility, with the less likely scenario of a hard landing, where the Fed is very aggressive for all of this year, potentially even raising rates much more than 5%, and they really do a lot of damage to the housing market and consumer demand.
The discipline index is designed to measure macroeconomic risks, things like credit spreads, the yield curve, labor market risks, stock market valuations. It takes all these things and crams them down into one simple, clean indicator that gives you a sliding variable measure of how much economic risk is currently priced into the stock market.
You've got a lot of ingredients for higher than average macroeconomic risks in this environment. And so things like credit spreads widening, the yield curve flattening, growth slowing, and the Fed tightening all creates this potential for asymmetric risks. And so the discipline index is consistent with a risk off or an underweight perspective on longer duration, high risk assets. Let's talk about some specific asset classes, starting with the dollar index, which is so crucial to everything in the global economy. My base case is that the Fed is going to hold while foreign central banks are very aggressive. So the Fed moves to 5 and the other central banks all play catch up, which results in a marginal decline in the dollar index over the course of the year. The bull case for the dollar index, ironically, is a very bad one for the U.S. economy, where the Fed has to ease, deflation is ensuing, and recession is occurring. And so demand for dollars surges. Well, the bear case for dollars is that the foreign central banks tighten much more than expected, resulting in the dollar index on a relative basis falling versus foreign currencies. Before we go on, let's talk about what we're talking about, which is time. And although I'm talking about everything inside of the 1 year time horizon, it's really important to keep things in the proper perspective because we're talking about a lot of asset classes here that have inherently very long time horizons. So even something like a bond aggregate has at least a 5-year time horizon. Using my all duration methodology, something like the global stock market has about an 18-year time horizon. So try to keep all of that in perspective as we're navigating this. There's a lot of guesswork involved in what any instrument is going to do inside of a 1 year time horizon, especially for all of these longer duration instruments. Bonds were terrible in 2022 as the Fed moved much more aggressively than a lot of people expected, myself included. But going forward, I think that the vast majority of the Fed's move is now behind us. So if they hold at 5% as I expect, that means that bonds will do just okay going forward from here. The bull case is, ironically again, a very bad scenario for the economy where the Fed actually is forced to ease because we're getting deflation in a deeper than expected recession. The bear case is that inflation takes hold to the upside. You get sort of a 1970s style scenario and the Fed ends up tightening even more than they already have, resulting in further interest rate increases and bond price declines. One important thing to keep in mind with bonds is the rising amount of credit risk that's resulting from the Fed's aggressive positioning. So surging interest rates are going to result in a lot of credit resets in 2023 and 2024. This is especially true in foreign markets and places where adjustable rate mortgages are much more widely used. So 2023 is likely to turn into a year where credit risk becomes a bigger concern relative to the 2022 risk, which was just rising interest rate risk. The stock market's an 18-year instrument using my all-duration methodology. So let's keep that in perspective as we talk about a 1-year time horizon. But we know that based on historical metrics that the stock market is riskier today than it is on average, given where market valuations are and things like the inverted yield curve and the aggressiveness of Fed policy. So going forward, I think it's reasonable to expect a base case of lower risk-adjusted returns than we're used to. The bull case for this scenario is that the economy actually surprises to the upside and the Fed holds. Inflation falls faster than expected, and you get this sort of Goldilocks environment. The bear case going forward is that the Fed tightens much more than expected because you're getting a 1970s style environment, or we get a 2008 environment where credit worsens much more than expected and deflation takes hold. In both of those scenarios, the stock market does very poorly by my estimate. So there's a lot of potential for asymmetric risks in this sort of an environment, and that raises an important question. Do you need portfolio insurance or not?
This is a super important question. It's one that I've often struggled with pertaining to certain asset classes like gold and options. How much of these things should you really own in a portfolio? And those things are obviously super personal. But the bottom line is, I think that years like 2022 make people realize that you'd rather have insurance and not need it than need it and not have it.
I like to think of portfolio insurance kind of like term life insurance. You buy it not for your whole life, but for a term during which you know the risks are asymmetrically skewed for people who are dependent on you. That's just good financial planning. And the same is true of portfolio management. We know that there are certain environments where the macroeconomic risks are higher than usual. And we're in one of those environments right now, where the potential for all of these unusual asymmetric outcomes is just higher than it is on average. I like to think of my portfolio across a bell curve of different asset classes, where the cash flow generating instruments, the ones that are generating long-term reliable returns, are the core of the portfolio. But they're buffered by short-term principal insurance type instruments, things like cash and treasury bills and short-term bonds, as well as tail risk insurance instruments in certain environments. That's what gold, options, long-term treasury bonds, actual insurance, and even commodities can provide in certain macroeconomic environments where the asymmetric risks are higher than usual. My preferred approach to all-weather investing is to use what I call an all-duration investing strategy, which means that you're not just diversifying across asset classes. What you're really doing is you're diversifying across time and trying to provide certainty of assets relative to your own liabilities across specific time horizons. Based on all of this, it's clear that the macroeconomic risks are still sort of asymmetrically skewed to the downside. And that means that long duration instruments are just going to be more volatile, lower risk adjusted return style instruments going forward. At the same time, things are starting to look a lot more attractive. Things especially like cash and bonds have improved significantly. Stocks are getting there, but I think compelling argument for portfolio insurance remains in place as we sort of digest the COVID boom. So in summary, the irrational exuberance of the COVID boom is something that's taking time to process. It's almost like we ate a huge meal and we're just digesting it. And that's just going to take time. So in the meantime, though, there are asymmetric macroeconomic risks that remain in place as that process unfolds. But it's not going to be the end of the world. This too shall pass, as they say, and we'll all get back to living our lives and another bull market will ensue at some point. But in the meantime, patience and discipline are going to be your best friends.
Happy New Year!
Yeah, she's pretty cute, huh? I think I'm going to keep that one. Guys, Happy New Year. I hope it turns out to be a great one. More importantly, I hope some part of this video helps you to navigate it a little bit better. Take care.
Thanks for watching, everyone. I hope you learned something new, and I'll see you next time.